Investing in the stock market is boring. Stock market is not recovering. Stock market is a trap. The Wall Streets are scumbags that are cheating our money. Should I still invest in the stock market? That is a question I want to address to you today, yes or no, and help you decide if you should stay in or leave. I will say that you should leave the stock market if you think that you want to see explosive boom, you want to get rich really quick, you want to see a company triple in the same year alone when they just started up. The stock market is not for you. Why? Because the stock market is in a state of recovery. We have just left a post-war, post-pandemic situation, post-crash, and we're going to recovery mode where things will be slowing down. Sometimes some companies will be retracing back. And if you're looking for more explosive boom, I'm afraid that you'll be disappointed that you're not going to see that anymore. Things are starting to settle down, and then this is where we should be on cruise control mode. So stock market is not for you. Perhaps the crypto boom is the place to be if you want high risk and high returns. But if you're one of those disciplined, stock market is a passive investment that you can leave and let it run. You're a long-term view investor, and you're one of that investor who believes in the compounding effect. And when you invest in a company, you invest in the business because you want to be part owner of the business, then stock market investing is for you. To convince it even further, I want to share some data with you. First one, the long-term view is always a great view for long-term investors like you and me. Why? Look, S&P 500 has been increasing on average 9 to 10% over the last 90 years. That includes the wars, that includes the depression, that includes every single crash, and yet there's an average of 9 to 10% increase throughout the 90 years alone. And the second thing is data is king, not cash. Data. With information, you can forecast what's ahead. All I want to say is ignore all that noise that you hear every single day and only focus on company earnings. It's only 4 times here. And recently with company earnings, we can see which companies are still growing, which companies are still expanding, which companies are still making profit, which companies are still reinvesting their profit to grow their company even further, to disrupt, to grow, to improve human lives. These are the companies you should invest in for growth, dividend, or even compounding effect for the future. And third, you need to focus on the compounding effect. Outside the investment, you need to believe that you have to consistently invest on a regular basis. You have to put money in. Because end of the day, if you invest in a company that's got 10% growth, you are looking at an average of 7 years to double your money. If you're looking at a company an average of 15% growth, you're looking around about 4.5 years before it doubles. And if you're investing in a super high growth company, like 20% growth every year, you're looking at 3.6 years before it doubles. Where do you find those? Let me give you an example. Apple, Netflix, Microsoft were these companies, and these are the companies that you know as well. And the fourth point I want to address, not just being a long-term investor, but you have to be disciplined by keeping your portfolio small. You should perhaps just focus on 5, 7, less than 10 companies. You should focus on the top 3 companies or top 5 companies with higher concentration, everything else as a rotational stocks that you should put in. This is the way that you should invest. Keep it simple, keep it easy, keep it manageable, and then keep on top of things with the minimum most amount of time that you can afford. And finally, last point to convince you that why you should be a long-term investor, why you should keep to the stock market is we have just come out of a crash. And every investor invested in 2020, I can reassure you that you will do well in the next 5 to 10 years. Look at data. I have met millionaires, early retirees who invested in 2007 to 2009 when everybody was running away from the fire. They invested when everybody was fearful. They picked up stocks at really cheap rate and they kept investing up to as far as 2012, 13, 14, 15. And most of these people, by the time 2016-17 came, these people had more money than their day job. The money invested is regenerating more income than their day job, and that's when they call retirement a retirement early, so they can focus on other avenues. That's why it takes discipline, It takes a long-term view, it takes commitment, it takes understanding, it takes data. That is what investing is all about. And most importantly, it's passive. It's been done in the background. You don't have to do the hard work. You're letting these quality companies do the hard work for you. So this is me to convince why you should stay in as a long-term investor, because it is just part of the journey that everybody walks who wants to get passive income to help them retire early. Thank you very much. I hope you enjoyed this. Like and subscribe for more motivational videos like this in future, and all the best in your investment journey.
I hope you enjoyed that video. If you want to see future videos, please subscribe to the channel and press the bell button. Ding dong! More videos.